introduction. So we are going to discuss ESG investing. And so ESG investing has now clearly found its way into the mainstream of asset management, and ESG investing has found its way into the mainstream of indexing and in particular equity indexing. So I'll be joined today in the presentation by Eric Christiansen. So actually I first met Eric about 10 years ago when we designed an equity index, which was a smart beta index, and it also included an ESG dimension. So this was quite a complex task back then. So I think, achieved a nice strategy. The mandate is still running 10 years later. But it was quite complex actually to put together an in-house ESG expertise at a pension fund with an index provider and some quantitative research on portfolio construction. And when we did this 10 years ago, it was clearly something that was quite unusual. Today, things are completely different. So any index provider will claim that they can provide you with a way to combine smart beta with ESG, and there's actually all kinds of different approaches that providers will claim are quite easy to implement to address this question, which we thought was a complex question 10 years ago. So clearly ESG has found its way into the mainstream, but a side effect of this is also there's a lot of conventional wisdom in the industry, which we would like to challenge. So there's a lot of misconceptions, and we will try to address some of these here. So the starting point is, well, why in the first place did ESG make it into the mainstream? The answer is quite simple. So investors actually in most cases do not only have financial objectives. Investors do not only care about risk and return, they also care about the contribution they may make with their investments. So there can be some externalities of these investments. So there could be externalities in terms of impact on society, impact on the environment. And here we will just focus on an example, which is climate change. So climate change is an externality which is quite extraordinary in its scope and its potential impact. And so this is why we focus here on climate change, but a lot of the arguments that we make apply in a similar way to other ESG concerns. So climate change, clearly, as Nordhaus said in his Nobel lecture, climate change is something that actually, basically threatens humans to go back, to the dark ages. And, in the most extreme climate scenarios, humans could actually go back to, the Stone Age. Of course, there's lots of uncertainty around this. We're not necessarily going to be in the most extreme scenario. Hopefully we'll be able to do something about emissions. And obviously there's some uncertainty around the precise effects still of a given rise in temperature, say. But clearly there's a big challenge and a big threat with climate change. Now, investors want to account for this, so they do not care about risk and return only. And there's basically three very different things that investors could get out of addressing climate change in their portfolios. So the first one is simply by accounting for such an ESG concern, investors may be able to align portfolios better with their values. So they would just feel bad about actually holding the worst polluters, receiving dividends from the worst polluters, and so forth. Okay, so they can actually align investments with their values. That's something that in practice you find really matters to people. In addition, investors may want to have a positive impact. So if you will, a positive social impact, a positive impact on the environment. So the idea here is, well, by maybe not investing into the worst polluters, not only will I be aligned with my values, but I may actually have positive impact that actually I'm doing something about reducing climate change. And the final point is that investors may want to hedge climate risk. So if you think that you could be negatively affected by, let's say, extreme weather conditions in the future, well, maybe you want to avoid stocks that likely would be very badly affected, and maybe you can benefit from holding some stocks that would actually hedge these risks. These stocks would actually pay off in very bad outcomes for the climate. So basically, there's these three different motivations for addressing such ESG concerns, and all of these matter for investors. Now, if you look at the conventional wisdom in the industry, the kind of marketing speech that you see in the industry is actually not at all aligned with these investors' concerns. So the industry basically sees that, okay, ESG is a new source of alpha. And this is a very common claim. So I think, you look at pretty much any provider's website, the claim is basically, we have found a new source of alpha. We're going to identify mispricing. Stocks with the right ESG characteristics will outperform. So the claim here is, well, you're going to make more money by actually, achieving all these objectives that I stated previously. So by doing good, you're going to also make more money. So this is a very simple claim that we're going to look into. And also what this claim ultimately leads to is that, well, ESG is just another alpha signal. Okay, so the industry has very standard ways of identifying alpha signals. So typically these are signals like momentum, like some accounting-based metrics, valuation ratios, etc. The industry has, approaches to integrating these alpha signals. So if we just say that, carbon emissions or other ESG concerns are just another alpha signal, well, we can actually just close our eyes on the actual questions at hand, and we're just going to integrate that just in the old way. Okay, we just do exactly like before. We're just changing the data from accounting ratios to ESG ratios, and we're done. And this is another clear tendency in the industry. So we're going to ask really three questions to challenge this current practice. So the first question is, the question of performance. So is there really a premium, so a green premium? In the literature also sometimes called the greenium. So is there any premium to holding green assets? So the idea here is that these assets would actually deliver some alpha. After that, we'll turn to the question of, how should we actually design portfolios? So is there really a benefit to using these ESG scores, just like alpha scores, in the traditional way of constructing portfolios? And finally, we're going to look at the signaling that is inherent in portfolios. So clearly, when you want to influence companies in terms of changing their practices, you have to think about the signal that you're sending. So Eric will talk about these signaling aspects. So let me start by thinking about the premium. Okay, so should we expect outperformance from holding green assets? Again, you could apply very similar arguments to say assets that focus on social objectives. Okay, so here we're just going to talk about green objectives and really as they relate to climate change. So the first question is, well, what does theory have to say about this? Whenever you think about possibly finding a premium, you may recall from discussions on factor investing and factor premium. The first question is the economic rationale. Okay, so is there actually anything that would lead us to expect that we should get a premium from tilting to these stocks? So here we're doing the same. So we're asking, is there actually any theory that would lead us to expect a green premium? So there is a recent theory paper by Pastor, Sternbauer, and Taylor. So they analyze really the effect on asset prices of sustainable investing or green investing. So this is a recent paper, but actually a lot of the, I think a lot of the conclusions really go back to, let's say, very fundamental assumptions that they make and could be found and actually are found in other theoretical papers on this subject. So what is their theoretical prediction? Well, what they actually predict based on a fairly standard model is that there should be lower returns for green stocks. Okay, so we should actually expect underperformance for green stocks. And this is for two reasons. The first reason is because of the non-financial benefits that investors get. So they basically start with a very standard model, and then they assume that, well, investors actually care about the kind of stocks they are holding. So stocks with a high green score or with a high ESG scores, well, they're actually stocks that have, if you will, a positive externality. Okay, so they help to, if you will, clean up the environment, or at least they pollute much less than other stocks. So investors will value that. And because they get these benefits from these stocks, well, they're actually willing to hold a greener stock at a lower level of expected return. Okay, so this preference for greenness will actually drive up the price of green stocks. So that's a very sensible prediction. A second reason why long-term returns would be lower for green stocks is that, well, they may help to hedge climate risk. Okay, so if these stocks help to hedge climate risk and investors care about climate risk, well, again, if you're getting insurance from a stock against bad outcomes, you should be actually willing to pay more for that stock, and that means you're going to accept a lower expected return. So the case is quite clear that in the long term, because you have these non-financial benefits, you would actually expect that you will get something less in terms of the returns. Now, does that mean that empirically we're going to observe underperformance? Well, not necessarily, especially not over short time periods, because they show also a different effect, which is the effect of shifts in preferences. So again, these lower long-term returns really come from investor preferences. So they have ESG concerns, and these concerns could become stronger over time. Okay, so there's a channel of investor preferences. So if investors get more concerned about about climate change, then that will actually drive up the valuation of green stocks, and so that could lead to short-term outperformance. Of course, the flip side of this is that in the long term, returns will decline even more if preferences shift. A second channel is a consumer channel. So the consumer channel just means that if not investors, but consumers actually care more about climate change, they will avoid products from brown firms and they will like product from green firms. And so that will actually increase profitability of these green firms. And again, that may drive up stock prices. So there's really a key challenge to disentangling the short-term effects from the long-term effects when we look at the data, and any short-term outperformance could just be a sign of shifts in preferences and is not necessarily a sign of a long-term premium. So this is a theory. Now, what do people find when they look at the data? So there's a couple of papers looking at carbon emissions. And I'm just providing here an overview of a few key findings. So the first type of study just looks at carbon emissions. So there's a recent paper by Bolton and Kashperchik. So they find that the brown firms actually earn higher returns than the green firms. So this is when you look at carbon emissions. So again, here, this suggests there's actually an underperformance of green firms. Now, this is what they find with the magnitude of emissions, so basically taking tons of carbon emitted. If they normalize by revenue, so they take a measure of carbon intensity, tons emitted divided by dollars of revenue, they actually do not find any difference in returns. Other papers go a bit further and look at composite carbon scores. So you may argue that looking at emissions is too simple to really capture how green a firm is, even in terms of carbon risk. And so there's several papers that combine different metrics. So you have one study that actually looks at 55 different metrics, so ESG metrics, and combines them. So these are variables such as research and development on environmental issues, procurement policy, how energy intensive the company is, etc. Another study looks at not just carbon emissions, but also the level of disclosure that the company has. And so these papers combine these different scores. Now, these papers, again, find that brown firms actually earn higher returns. So again, this suggests underperformance of green firms. And finally, there's a recent paper that looks at a slightly more complex setup. So what this paper by Chima Fox does is they basically look at flows into green stocks by institutional investors, and they show that you can use this information to time by basically moving into these green stocks when institutional investors move into these stocks. So that strategy, they claim, generates an alpha, but it's also clear that that is not a kind of static exposure in the long term. It's actually a timing strategy, and obviously you could time any factor that doesn't have a long-term positive return. So looking across these different studies, there is basically evidence that perhaps there's a negative premium, maybe there's a zero premium, but there isn't really anything that would suggest that green stocks are a source of outperformance. Now, let's go back to this empirical question, and let me try to illustrate these findings by just looking at an analysis on recent data. So we're looking here at 15 years of data, and we'll construct a long-short factor, okay, just to see whether we find any premium on this green stock. So we call this the green minus brown factor. It uses carbon intensity, and we're just going to construct a standard long-short factor. And here's what we get in terms of results. So first of all, looking at different versions of this green minus brown factor, what you see here are the recent returns over the past 15 years. Now, what are these different versions? Well, we simply look at green minus brown factors that weight the stocks by market cap. Another version uses equal weights, so you're going to have less bias towards the largest cap stocks. And we also have two versions where we are removing any sector biases. So we're just constructing the long and short leg so that any sector exposures cancel out. Okay, so there's no, if you will, positive weight in the long short portfolio on any industry. And what you see here is that, well, this factor had, first had some losses in about the first half of the sample until 2011, and then returns have been positive going all the way to today. So this is the type of chart that you may see from some providers who then claim that, look, it outperforms. Clearly, this curve points upwards, but obviously, just looking at returns in this way over 15 years doesn't actually provide much information. We would have to actually conduct a proper test to see whether there is any premium. So this is what we did here. So we just first looked at the annualized returns of these factors, and we're also reporting the t-statistics. So you can see here already in the first line that the annualized returns, while positive, are actually not statistically significant. So we can't actually be confident that they're different from zero. And so even the kind of the gross returns do not suggest that there is a premium. Of course, we also have to be concerned over exposure to existing factors. So we want to adjust for other factors. So if we adjust just for the market factor, we actually see that the return of the cap-weighted green minus brown factor actually decreases to a level of 1.25% annualized. And then we adjust for further factor exposures. So we're also adjusting for not just the market factor, but 6 kind of standard style factors. So things like size, value, momentum, and also low volatility and quality related factors like high profitability and low investment. So when we adjust for these, we actually see that the remaining return is actually very close to zero. Okay, so in this case, it actually becomes negative. So the return goes from about 2.11% to minus 0.58%. Okay, so none of this is significant. So for practical purposes, we can't say that these returns are different from zero. But clearly, any effect that you see, even if it's not significant, you can just relate that to the factor exposures, and you can confirm that directly. So if you look at the factor exposures of these green factors, we can see that over that period, these green factors actually had a bias towards a high market exposure and also high profitability exposure, right? So once you adjust for these, you actually don't see any effect. Now, what's the implication for investors of these, this absence of any premium? Well, the implication for investors is clearly that, if you actually believe in outperformance of a green factor and you design your portfolio accordingly, this will actually be costly. Okay, so you're going to have a loss because of this wrong belief into a green factor. And so we're just showing the implications here by fixing an allocation to the green factor. So the idea is, well, an investor is just convinced that there is outperformance from this green factor. And then he's going to combine that tilt to the green factor with the 6 other factors. So we're just comparing this outcome with an outcome where the investor actually knows that there is no premium to the green factor. So basically what we're doing is we're just fixing the weight of the green factor, and we're just looking at the loss in risk return that an investor gets. So what you see here is if, for example, an investor fixes the weight of the green factor at 20%, you get about a 60 basis point loss in excess returns, and you get something like a 20 or slightly more than 20% reduction in the Sharpe ratio, more like 25% reduction in the Sharpe ratio. This is simply because you're tilting towards this green factor even though there isn't any premium. And so the bottom line really to this is that, well, unlike what the industry marketing speech suggests, there is a trade-off, right? So there is a trade-off between financial performance and green objectives. And so you should think carefully about your green objectives and how to best achieve them. And you shouldn't actually just mix green exposure with all kinds of other exposures as if the green factor was a factor just like the other factors. So it's actually quite dangerous to think about ESG and green investing, put it into a mix with all kinds of other factors that you've heard about, because you're actually not doing justice to the nature of your green objectives. And this is something we can show also when you think a bit more carefully about portfolio construction. Okay, so we're going to look at what happens when we use the kind of standard industry way of mixing up green exposure with factor exposure. What actually happens in that case, and how does that compare to an approach where we're actually keeping the green objectives and the financial objectives separate. Okay, so we're just comparing here two approaches. The first one is a filtering approach. So in the filtering approach, we just exclude the worst polluters. Okay, so we're going to exclude basically 10% of the stocks that have the highest carbon intensity. And then once we've done that, we're addressing financial objectives through factor exposures and through diversification objectives. We're comparing that to an approach where you just throw everything into an optimizer. So this is really the kind of traditional way of doing that, right? So, well, your carbon score is, for you, is just like a momentum score. Okay, your carbon score is just like a quality score. Okay, you don't care, all of these things for you are the same. It's just an alpha signal, and you're just going to mix them up in a single optimizer. So we're just going to actually compare these two approaches. Maybe just to clarify, so in detail, what we do is, well, we're going to combine a factor with this carbon score. So in the filtering approach, we're just going to tilt each index to a rewarded factor. So we're going to remove 50% of the stocks that have a low factor score, and then we're applying a high factor intensity filter just to address interaction across factors. Again, none of these methods that target factor exposures actually look at any kind of green exposure. So the stocks that have the poor performance in terms of green, they've been removed. Okay, and so once we've done that, we're going to use a diversification scheme to just diversify the stock-specific risk. And we're comparing that to an optimization. So again, the optimization, we're just maximizing a composite score. To make things comparable, we're just going to target to have the same level of tracking error as the same index in the filtering approach. And we're going to do that for each of the 6 factors. Now, here are the results. And the results are really quite clear cut. So what you see, so this is over a 10-year period, what you see is that there's really nothing to be gained from this complex optimization approach, right? So if you think in terms of Sharpe ratio, the Sharpe ratio is actually, slightly lower than the Sharpe ratio you get from filtering approach. Also, if you look at the information ratio is clearly lower than what you get from the filtering approach. So you don't actually get anything out of this score-based optimization in terms of financial performance. There's no gain in risk-adjusted performance. You do, however, see an important increase in implementation hurdles. So you see that the turnover increases very substantially. So from something like 40% to actually about 100%. And you see that the concentration levels increase tremendously. So you're going from an effective number of stocks of more than 100 in the filtering approach to only 28 in the optimized approach. So by actually exploiting this stock level information, you're just going to load very highly on these factor champions that have the right factor exposure and the right carbon score. And that's going to create very concentrated portfolios. So the bottom line really to this, this question of portfolio construction is that, much ado about nothing. So you can have a complex approach of optimizing across a composite score, but you're actually only going to get problems out of that. You're actually not going to get any benefits out of that. And there's actually very good reasons why this is the case. So the first reason is simply that dealing with this stock level information just exposes you to a lot of noise. Okay, so there's never going to be a clear relationship at the stock level between any score and a return to that stock. You're just going to pick up a lot of noise. The second reason, of course, is that we've seen that there is actually no information about returns in this green score, right? So it's not even a factor. So it's not going to give you any, you're not going to get any value out of exploiting something that isn't a factor in a very detailed manner. And the final reason why you don't gain anything is that, well, you are giving up on diversification. And while I emphasized, the importance of trade-offs, well, when it comes to diversification, we know this is the only free lunch in finance, so it doesn't seem to be a good starting point to give up on diversification. So with that, I will hand over to Eric, who's going to talk about the signals involved in these strategies.
Okay, thank you. I'll just share my screen. Okay, thank you. So in the first part, as Felix mentioned, there are different motivations for implementing a low carbon strategy. One could be hedging climate risk or a purely financial objective. And as Felix shown in the first parts, we've seen some of the problems linked to optimization techniques, the score weighting techniques when it comes to the financial outcomes of such low carbon strategies. Another motivation for having a low carbon strategy is simply to have an impact. The investor wants to help tackle climate change. And in order to do that, he wants to influence companies. He wants to make the behavior of companies more carbon efficient, or he wants to reduce carbon intensive activities. And so what I'm going to look at now is the difference in impact from a climate change perspective between two types of low carbon strategies. One, a purely simple, straightforward filtering strategy where you remove the most carbon intensive companies, and then within the filtered universe, you apply your factor strategies, you apply your diversification techniques. So that's a filtering approach, an exclusion approach, or a screening approach. These are the same synonyms in our minds to construct a low carbon strategy. And we're going to compare that to an optimization approach, which some providers purport to be a more complex, more sophisticated approach to building a low carbon strategy. Now, so first, we'll look at the implications in terms of having an impact on climate change from divestment strategies. And filtering strategies are just basically ex ante divestment strategies. Now, some people claim that having a filtering approach is purely a passive bystander approach, as they call it. They see it as, instead of being a form of action, they see it as a form of capitulation towards polluting companies, for example. So they see divestment as simply transferring the ownership of the company from one investor to a more willing one, to one that accepts a more polluting behavior from the part of the company. And some people even claim that divestment makes it worse for stakeholders, or make it worse for the climate, because we could potentially push companies out of public markets into more opaque private markets, for example. But this claim is not reasonable. So what actually happens when you divest, what happens when you implement a filtering strategy, is that By selling the companies, you push down the price of the stocks. And this is the same as saying that divestment leads to an increase in the cost of capital of those companies that the investor objects to. And this hampers the ability of the company to invest in new projects. It hampers the ability of companies to basically be active in sectors and industries that pollute. For example, if the pollution is the objective of the filtering strategy. So it's not a capitulation, it's an active strategy by raising the cost of capital of the companies that you divest from. How does this raise in cost of capital occur? The first and most obvious way is that by selling the stock, the actual selling pushes down the price and thus increases the cost of capital. But there are also indirect ways in which divestment leads to an increase in the cost of capital. And that's through what some people call reputational damage, or what you could also see as a normative process. So basically all these investor coalitions that we see that create divestment campaigns, this contributes to creating new norms in society. So it basically threatens the license to operate of companies or industries that pollute. And this, of course, is anticipated as a source of future risk by markets, and thus they attach higher cost of capital to those more risky companies, since the license to operate of those companies is threatened in the future. So this means that it's not only the actual selling that contributes, but also the signaling effect of divestment that contributes to having an impact on the company's behavior. So this signaling effect is very important when you try to build an effective low carbon strategy, if you want to actually have an impact on climate change, if you want to contribute to tackling climate change. And here we have a quote from a paper from 2016 from Mats Andersen, who was head of AP4 at the time, and Professor Bolton, and also Fredrik Samama from Amundi. So they wrote a paper at the time that they launched one of the first low carbon strategies in the market. And what they have a discussion in that paper on different ways to construct the low carbon index. And this is a very simple low carbon index in the sense that it's not a factor index, it's just an index that tries to have a low carbon footprint and at the same time have a low tracking error relative to cap weighted index. So it's not a factor index, it's a very simple form of a low carbon strategy with low tracking error relative to cap weighted benchmark. And they discuss different ways of building such an index. And in particular, when they come to the discussion of what to do with the most carbon intensive companies, should you exclude those companies? Should you filter them out? Should you divest from the most carbon intensive companies? Or should you keep them in the portfolio and, for example, downweight those stocks instead of completely removing them from your portfolio? And what they claim here, and we completely agree with this idea, is that by having a filtering approach, a divestment approach, you send a very clear signal, and this helps discipline the companies which have been excluded, so they understand that they have been excluded, and they therefore understand that they are penalized by that. And it also creates an incentive for companies that have been excluded because they want to be re-included in the index. And since the filtering is updated every year, they have an incentive to improve their carbon intensity from year to year and to be re-included in the index in the future. So this here, we just insist on the importance of having a clear signal, because that's how the management of the companies will be able to react, because they understand clearly the signal from the construction process of the index. Now, that's, let's say, from a theoretical perspective, what the impact of divestment can be. Now, from a more empirical perspective, what is the impact of divestment? And there are some papers, in this paper from 2019 by Doherty and Weber, for example, they look at the effect on the cost of capital of fossil fuel industry from different divestment announcements. And it's important here to have in mind that this is announcement of divestment. It's not the actual divestment, the selling, it's the announcement effect, which is basically the signaling effect of the divestments from different campaigns. And they show that these different fossil fuel divestment announcements have had an effect, and they analyzed 24 different events in this study. And interestingly, one of the most impactful events was when the Oxford University Endowment announced that they would divest from their portfolio. And the Oxford Endowment is fairly small from in terms of assets under management, but because of the reputation effect it has, being linked to an prestigious academic institution, this had significant effects when they announced that they would divest from their relatively small endowment. So that's an interesting point of the importance of signaling as opposed to the direct impact of divestment from the actual selling. Now, there is some uncertainty when it comes to the question of what percentage of investors, what percentage of shareholders need to divest before there is an actual impact on the cost of capital of companies that are divested from. And some researchers point to, let's say, a rough idea of about 20% of investors needing to filter or divest before there is an actual impact. And this seems like a fairly high threshold. But if you look at the numbers of ESG strategies, the amounts of sustainably managed assets worldwide today, this threshold of 20% has been actually reached, and sometimes very far. The actual numbers are far above 20% in some developed markets. The only market where we are still below 20% of ESG assets compared to the total assets under management in that developed market is Japan. In Europe, for example, we're close to 50% of total AUM, which is managed according to some kind of ESG strategy. And when you look at the breakdown of these different ESG strategies, by far, the most popular way remains filtering approaches or screening approaches, either norms-based screening approaches or what is called negative exclusion approaches, are still about 2/3 of total AUM in terms of ESG strategies. So if you take, for example, in Europe, 2/3 of 50%, that's still way above 20% of ESG managed assets that have some kind of exclusion strategy attached to it. And if you look at what types of exclusions are implemented in these divestment strategies, if you look at some issues such as tobacco screening, if you look at coal exclusions, for example, which is more to the point when it comes to climate change, which we are discussing as an example today, we are probably above this threshold of 20%, at least in some markets already when it comes to coal, for example. And interestingly also, we can note that it's not certain that the effect is purely linear, that once, for example, we've reached this 20%, that it's going to be a gradual increase in the cost of capital. Some researchers point to the existence of tipping points, meaning that once we have reached a certain threshold, so for example, 20%, there is a tipping point, a very sharp rise in the cost of capital of those companies which have been divested from. That's a potential risk also for these companies. Now, so what we discussed until now is the impact from very straightforward divestment strategies or filtering approaches. Now what we're going to look at now are the impact of more sophisticated, or at least what is claimed to be more sophisticated approaches which use optimization techniques or more simple score weighting techniques to build a portfolio. So what they do here is, instead of filtering the universe and then applying the factor strategies within the filter universe, they mix, for example, carbon signals or climate signals with financial signals in an optimization. And one reason for doing that, at least it is claimed to be so, is that if you don't completely divest from the company, you can still be a shareholder. And then some people claim that to be able to engage with companies, you need to remain a shareholder, that you can only have shareholder engagement if you remain a shareholder. And so this is one reason, at least is claimed for doing that. But what we will show now is that such mixing strategies, such optimization-based strategies, send very blurred signals. So instead of sending clear signals to companies, you basically create companies, you create portfolios which are completely unintelligible from the point of view of the company. So if they try to look at the weights and the evolution of weights of stocks in the portfolio, they cannot actually guess or even understand what the investors' preferences and intentions are in terms of climate change, for example. Now, here we take a very simple example. So this is the simple example of a mixing strategy. So you just mix a carbon score with the most simple input in terms of financial metric, which is, let's say, the market cap weight. So it's a carbon tilted cap weighted benchmark. So you overweight companies based on the carbon intensity relative to a cap-weighted benchmark. So you overweight companies with low carbon intensity, you underweight the most carbon intensive companies. And what we show here is that, and we look at the weights over time. And what we show here is that if you look at, in the right column, we look at the very worst carbon intensive companies. So the 10% worst carbon polluting companies in that universe at that point in time. And we see that from year to year, if you look at the weight of these most polluting companies, they actually increase from one year to the other. So roughly 50% of the time, from one year to the other, the weight of the most carbon intensive companies, so the most polluting companies, actually increase from one year to the other. And in a similar way, if you look at, instead of looking at the most carbon intensive companies, if you look at companies which from one year to another become more carbon intensive. So if you want to send a clear message to a company, you would probably want to penalize companies that become more carbon intensive. So what happens here when we look at the companies that become more carbon intensive is that almost 50% of the time, their weight increase from one year to the other. So if you are, let's say, the CEO of a company which is very carbon intensive, or you're the CEO of a company which actually becomes more carbon intensive from one year to the other, if you look at what happens in the portfolio of this low carbon index, is that the weight increases. So the message is, of course, it's completely opposite to what the intention of the investor is, because he has invested in a low carbon strategy and he believes that he sends a clear message, but he actually sends an opposite message to what his intentions were. Now, in this example here, we'll look at simply a slightly more sophisticated approach. Instead of over and underweighting relative to a cap-weighted benchmark, we create an optimized portfolio. And we compare two strategies. One is a straightforward multi-factor index, such as the ones we create at Scientific Beta. So we remove, in particular, the 10% most carbon intensive companies from the universe. And then within that universe, we select stocks which have certain factor characteristics. So we select value stocks, we select momentum stocks, and we weight them in order to diversify stock-specific risk. So that's, let's say, a simple step-by-step approach to building a factor index, where the first step is filtering out the most carbon intensive companies. And we compare that straightforward filtering strategy, filtering factor strategy, to a strategy where you use an optimizer. So you create you put as an input the carbon score, you put as an input a multi-factor score, and you achieve the same level of carbon intensity reduction and the same level of multi-factor exposure as in the filtered index. And then once you have achieved the same level of factor exposure and carbon intensity, you just minimize the tracking error relative to cap-weighted benchmark. So basically what we compare is a filtered factor index. We compare that to an optimized factor index. And what we see here again, if you look at the right column, is that if you look at the weight of the very worst carbon intensive companies, the 10% worst carbon intensive companies, these weights can increase from one year to the other. And also, if you look at, sorry, that was the middle column, but also if you look at the right column, if you look at the weight of these very worst companies relative to the cap-weighted benchmark. So remember, this is a factor strategy, so it's not anchored to cap weights. But if you want to compare the weight of the worst carbon-intensive companies to a cap weight, so let's say a simple market benchmark, sometimes you end up overweighting those companies relative to cap-weighted benchmark. So you believe you have a very sophisticated, optimized approach to a low carbon strategy, but what you actually have is a strategy where you overweight the most polluting companies relative to cap-weighted benchmark. So if you are, again, the CEO of such a company, such a very extremely polluting company, and you look at how this portfolio is constructed, you would not be able to actually guess that this is a low carbon strategy. You would think that this is a high carbon strategy, since you have overweighted some of the very worst companies. So this, again, sends completely opposite signals to what you should send if you want to incentivize CEOs, and if you want to incentivize companies to become more carbon intensive, less carbon intensive. So again, the message is, if you want to have an influence on companies, it's much better to send a very clear signal, just divest from the worst polluting companies. That sends a clear signal to CEOs. that basically, if they are carbon intensive, they will not be part of your index. And it also gives them an incentive to act, because if they improve the situation next year, at the next review of the filter, they might be re-included in the index. Whereas if you use a more sophisticated or complex, I would say, strategy where you mix financial signals and carbon signals, you might end up sending completely opposite messages to what you intended to do. Now, in terms of conclusion, I hand back to you, Felix, for the conclusion.
Yes, so thank you very much for that, Eric. So yeah, just to sum up the key points really of what we presented. Clearly, you know, we discussed that ESG has entered the mainstream. And along with that, you know, there's a very simple, actually, idea about ESG and green investing and carbon investing, which is really that, well, you know, this is just another signal, you know, just like any other signals that the industry has been using, but really believing in this ESG alpha is clearly costly for investors, because, you know, if you go to the basic economic principles, you will see that there should be, you know, if anything, a lower return in the long term by investing into strategies that have non-financial benefits. And so there could be short-term outperformance, but there's no reason to believe into a long-term premium. And also empirical studies clearly do not suggest that there is a premium. And so starting with this kind of fake alpha, so using alpha signals where there isn't any true alpha, will obviously compromise, you know, any risk-return objective. But in addition, it will also compromise the financial objectives. And I think what Eric has shown, you know, is kind of very sensible and actually very simple point, which is that, you know, mixing up these carbon signals with other financial objectives clearly sends a blurred message to management. And so in the end, you know, you're not going to get the desired alpha, but, you know, perhaps what's more worrisome is that you're actually compromising the actual green objectives that were really the starting point of choosing such an approach. So thank you very much for your attention. And I think we have time for questions from the audience.
Yeah, thank you both for the presentation. Yeah, it is now time for the Q&A session. So if you want to ask a question, you can use the raise hand sign appearing on your screen. We will then be able to unmute your microphone to hear your question. And we have already received a few questions through the Q&A function. So the first question we receive is, why do you think ESG providers insist so much on alpha? Maybe Felix for this one?
Yeah, maybe again, I can start on this one, and maybe Eric and Frederick can add something on that. I think there's, you know, probably a very simple reason, which is that, you know, alpha sells. So it's just a nice idea that, you know, if you can get extra return, that's actually very attractive. And so I think the industry just has a tendency to suggest that, you know, there's some ways of getting basically free returns without any trade-offs. So that's clearly a simpler sell than, you know, starting to explain that, well, you may get financial objectives, non-financial objectives, but, you know, that you may have to deal with the trade-off with financial objectives. So I think we've seen the same in factors. So, you know, factors are related to risk, but, you know, the industry has always insisted that factors are also alpha. So there seems to be I think a tendency beyond this particular area. And also, I think in a way you would wonder why would you actually sell alpha, because you know, you're setting yourself a very high hurdle, because, you know, if you sell alpha to investors, well, then you better also deliver on that alpha, and that's where, you know, as a whole, the industry doesn't really have a strong track record of successfully delivering alpha. But, you know, on the other hand, alpha is very difficult to measure. So, you know, by the time we have long enough track records and we've really figured out whether someone's claim to deliver alpha is, is actually verified. A lot of time will have passed, and you can't really it's difficult to hold people accountable for selling fake alpha. And I think also another point is simply that by doing this, so by saying that ESG is a source of alpha, you don't have to change anything. And this is kind of funny because precisely this is, I think, is actually a profound change from, let's say, standard investment management, is that we're actually looking at non-financial aspects. So we're looking at people's values, we're looking at the social impact of investment. So this is very different from, a standard old-fashioned approach. But in a way, you can be lazy by saying that, no, it's just the same. We use exactly the same, construction approaches, nothing changes, just we use an ESG score instead of a momentum score or something else. So I think these are maybe some of the reasons why we see that. But maybe Frederick or Eric want to add on this. I think there's some, there's some other reasons as well.
Yes, well, that's from the asset manager perspective. Maybe also it's attractive also from the asset owner perspective, depending on the regulatory environments. I think, let's say in Europe, regulators, in terms of their definition of fiduciary constraints, have been very open, actually pushing towards more ESG-friendly investments. So in Europe, that's probably not such a big problem. But if you look at the regulatory environment in the US, where basically, including in the latest developments, it becomes quite difficult for an investor bound by fiduciary constraints to implement an ESG strategy if you can't prove or claim that it's a source of additional returns or lower financial risk. So especially in the US, this idea that you can have some financial benefits from an ESG strategy is, of course, it's a benefit, but it's almost a requirement if you're bound by fiduciary constraints in the US.
Thank you. So another question we received is maybe environmental scores do not improve performance, but focusing on governance scores leads to better performance. Why do you not discuss using governance scores to generate performance?
So we chose here the environmental dimension, and even in the environmental dimension, you could look at aspects other than carbon scores. So this was really simply to look at the, really the first order issue first, and clearly, there's lots of important dimensions. So a lot of ESG providers will have something like 40 to 60 different dimensions. So we really just focused on one here that we think is particularly important because it's such a it's just such an important externality. Now I know there are debates sometimes about, in the ESG, is it, more the G than maybe some of the other scores that can generate performance. But I would say even on governance, if you look at on the evidence, I don't think there's any strong evidence that you can use these governance scores for outperformance. So there's a classic study basically that looked at the governance score and found that firms with a high quality of governance actually have better returns. But then the more recent papers actually went back to that and showed that, well, actually, if you have a longer time period, that conclusion actually disappears. So even there, I would argue there's no robust evidence that outperformance can be had.
Yes, I'd like to add here that the godfather of corporate governance, Lucian Bebchuk from the Harvard Business School, revisited this idea that there was a premium for the integration of governance aspects into investing, and found that after his initial work evidencing the existence of the premium was published, the market had learned, and even though you still had an association between governance performance and firm value and operating performance, when you looked at investment returns, the effect was gone. So that's a paper by Bebchuk in the Journal of Financial Economics in 2013. So gives a different color to this popular idea that there is a positive association between governance and performance at the investment, at the portfolio level.
Thank you. Another question: if an investor wants to engage and influence a company, it is surely better to be in a position of shareholder than to divest.
Yeah. Okay. Yeah, I can take that. This is a claim that we hear very often, that basically the best way to influence a company is to do shareholder engagement, and that in order to do shareholder engagement, you need to remain a shareholder. That's basically, you can't engage or have a dialogue with the company if you're not a shareholder. And this sounds a bit intuitive, it sounds a bit obvious, but we believe it's completely wrong. And if you look at it from a, let's say, a theoretical perspective, so equity markets are like any open market. So it's a marketplace where buyers and sellers of equity capital meet. And if you have an open market, sellers discuss, they have a dialogue, they take into account the demands of the different buyers. They don't want to restrict themselves to discussing with current clients. I've never seen any salesperson who says, well, you're not a current client, so I'm not going to talk to you. I don't want to sell you anything because you're not the current client. I don't care if you want to buy something. I just sell to my current clients. That's a very strange seller. So companies discuss with investors whether they are current shareholders or potential shareholders. That's if you look at just from a more practical perspective, you just look at the marketing material of asset managers. They talk about all these management meetings they have during the year, and of course they have management meetings with companies in which they are not invested, and that's the interest of these companies to have a dialogue also with potential investors. So both in theory and in practice it doesn't make much sense. And a very clear illustration of this is the rise of investor coalitions. So some engagement is still done between one investor and one company, of course, but this is fairly cumbersome. It takes a lot of time. So if thousands of different investors should have a dialogue with thousands of different companies, that would translate into, I don't know, probably millions of different meetings during a year. So investor coalitions tries to reduce this burden of engagement by grouping together different investors. And besides making it more resource efficient, it's also, and there are different papers looking at that investor coalitions, engagement through coalitions, is actually more impactful. So if you gather together a lot of different investors, you have a bigger impact on companies. So you have, for example, if you look at climate change, if you look at the IIGCC, and I just looked at their website today, how they present themselves, that's an interesting point. How they present themselves is, we are a coalition basically representing 33 trillion in assets. They don't say, at this particular date, we have invested X trillion in this company or this industry. They present themselves as representing a total pool of assets. And this is because these coalitions bring together current investors and also investors who at some specific point in time is not invested in a particular company. So you can be a member of a coalition, you can be a member of a campaign, even if you are not at any point in time an investor in all the different stocks that these different coalitions discuss with. So both from a theoretical and a practical perspective, it doesn't make any sense to claim that you need to be an current shareholder and that you can't be a potential shareholder if you want to engage with a company.
Thank you, Eric. Another question on the Doherty-Weber study. How can you segregate fundamental impacts from 2012-2019, which saw massive declines in fossil fuel pricing, from the actual divestment announcement impacts? Is it not possible that declining reinvestment rates from divestment announcements won't actually produce an impact on fundamentals in that industry, and thus positive investment signal on value into brown? That's quite a long question.
Okay, this Doherty-Weber study, it's an event study. So what they look at is very short-term impact. So it's, let's say, the stock market impact just around the event of the announcement. So it's a very short-term. So I think let's say the longer-term impact, where, let's say, the impact of the change over time of the oil price is less meaningful if you look at because this study looked at very short-term impacts. And but even in event studies, you can remove the short-term impact of the oil price over the period you look at. I believe they look at, let's say, a 1 week return or a few days around the event. You can just remove let's say the oil price, the impact the oil price has. You can create, let's say, an oil price factor, look at what that factor has for stock return over that period, and you can remove that in your regression. So I don't have the paper just in front of me, but I believe that's actually something that they do. So either you can remove it in the regression, or if you look at just an event study where you look at very short-term impacts, it's not perhaps not such a big issue.
Thank you. Another question: how reliable is the data disclosure? Are companies' carbon emissions data audited independently?
Okay, so maybe I can say a few words, and Enrique, if you want to add on this, you're free to do so. The data is voluntarily disclosed by companies most often, although there is a growing number of countries that impose emissions requirements on large companies or listed companies or companies from high climate impact sectors. When it's a regulatory requirement, the regulator may also include the need for the data to be audited. When it's voluntarily disclosed, the organizations that collect data, such as CDP, will recommend that the data be audited prior to transmission to CDP, but that's just a recommendation. So so yes, we could look at the percentage of the company emissions that have been audited. There is other steps that data providers can take to protect the quality of the data. For example, run some analysis on the type of emissions that they are seeing from a company, and try and verify that it makes sense relative to the sector and the products of the company. And as a matter of fact, this is something that many providers do, including our provider of carbon data. They have over 800 models based on sectors and products to verify whether the data appears to make sense. And if it does not make sense, then the data will be rejected and will be replaced by a sector-based estimation.
Thank you. We have a person that has raised his hand, so I will allow him to talk. John, you can ask your question.
Thank you. John Pantel, Greater Manchester Pension Fund. I found it very interesting today, but in the end, how do we actually change public behaviour to accord with our investment strategies? We may influence companies, but in the end, whether it's the United States, Singapore, UK, we've got to get people to change their habits to really deliver reduction in carbon footprint and reduce the risk for climate change. Any thoughts on that, gentlemen?
Well, we're not claiming that ESG investment is the only solution to climate change. I think there are many things that needs to be done, including, let's say, consumer behavior changes, regulation changes, and the way in which ESG probably has its biggest impact is through corporate behavior and the ability to finance polluting activities in particular. So So what the link is between, let's say, the influence that investors can have on corporate behavior and what this then has on consumer behavior, that's still an open question. There are, for example, Morgan Stanley has these surveys of individual investors' intentions and wishes, and what we saw in the latest edition, which was published last year. So every 2 years they have this market survey. It's a very sharp increase in investors, in particular among millennials, of investors of individuals who want to have their savings managed according to an ESG strategy. So the ESG market used to be largely institutional up until a few years ago, but now, at least as evidenced by that market survey of individuals, also individuals seek more, let's say, ESG conscious investment solutions. And that probably translates also the individual responsibility towards climate change, which is both through consumer behavior in terms of what types of products and services they buy, but also in terms of what types of investment products and services they buy.
Thank you. We have another person. Andrew, you have raised your hand. Andrew Saiwo.
Yes, my question was just, will the presentation be available?
Yes, of course. Yeah, you will receive an email with the recording, actually the recording of this webinar, as well as the materials, including this presentation.
Thank you.
You're welcome. So we received a few other questions, but I believe we have we are running out of time, so we will answer to them by email. And if you have any other additional question, please don't hesitate to email us. Our email address is webinar@scientificbeta.com. So thank you, Eric, thank you, Felix, and thank you, Frederick. And we will now end the webinar.
Thank you.
Thank you.